Hey, everybody. Welcome back to episode number 24 of the Real Deal Pod with Allister and Geoff, where we talk everything mortgage and real estate related. It is an absolutely beautiful, thank goodness the sunshine has broken through. It is a beautiful Wednesday afternoon. I hope everybody has had an amazing weekend, is having an amazing week so far. Geoff, my man, what's going on? How are you doing?
You know what? I'm shaking off this rust. We had a not the best week, but we are getting a great week coming up, or not a great
Yep.
week, but a great weekend. It's supposed to be sunny. It's supposed to be bright. And you know what? You give us 2 days of this, everybody's gonna forget all about that rain that we had last week.
That's exactly it, man. That's exactly it. Myself, just got back from Harrison, on the weekend. That's saying enjoyed the kind of sunshine slash majority rain out there, but it was still nice to get out and enjoy. And then got out and worked all weekend, man. It literally got home Saturday. I had to take my own car because I was doing showings in the middle of it. And then so right out, took my own car out to showings and out with my some beautiful clients and super excited. We got a upcoming listing, a town home in White Rock coming soon. A great set of clients of mine are going to be purchasing a condo in Morgan Creek. So it was a great weekend. Super good and
Fantastic.
super excited for this week. Yeah, and super excited for this sunny weekend as well. Hopefully we'll be able to get and spend a little bit more family time together, because it's the dread. Well, I'm excited because it's the long weekend. The kids aren't that excited because it's the dreaded can't say it back to S word, right? It's a swear in my household. It's a swear in
Yeah.
my household. It's the back to S. So I'm kind of excited because, the household gets quiet a little bit. I get to work in peace. But, I also miss it though, because it's sometimes fun to have the kids running in and to tell me something and joke around with me while I'm getting stuff done.
Well, you can just let them
I said
skip. You
almost
can
said
just
something
let them.
else.
You can let them just skip the SCHOOL and
Are you
homeschool them, Alistair.
Are you
Homeschool
crazy, man? Are you crazy? No way, man. I need my peace and quiet and sanity.
'em.
So, man, what are we doing? What are we getting in today? What are we teaching?
You know what? We're going to talk about homeowners that have equity built in within their home. A lot of times people that have equity within their home, they always want to pull that equity out to meet some type of financial goals. It could be to consolidate debt. It could be to do a home renovation. And, the big question is,
In my client's case, sorry for interrupting it, is possibly on the purchase of their new condo.
yeah, a down payment, right?
Yeah.
Um, and sometimes it's not necessarily a down payment. Well, yeah, on their new condo, which is an investment property, because again, you can't use a line of credit on a property that you're selling. But if you own a property,
Right.
you have equity within it, and you want to purchase an investment property and or another property, again, this is one of those things. How am I going to come up with the down payment? And more importantly, should I set up a second mortgage? Should I set up a line of credit? Should I simply refinance? Like, what should I do, or how should I go about it in order to access the equity? And I wanted to talk about that. Should you do a second mortgage? Should you do a line of credit? Should you refinance? And kind of just talk about the pros and cons and what each one of them are. Because a lot of times, I'll even speak for myself, um, we don't know what a home equity line of credit is. We don't understand that we can do a second mortgage with an existing lender that you have, with the existing mortgage that you have. You don't have to necessarily refinance. You can add segments onto something that you already have. And again, just to kind of get really a little bit deeper in that and on how people can access equity for reinvestment purposes, whatever that may look like.
All right. So what are the differences then?
Well, great question. So a
Thank you.
second mortgage is just what it sounds like. So
Good.
there are mortgage products that are out there. Maybe we've heard of Envision's Red Frog. Yes, I know they've changed that name, but Envision Red Frog, there's a Scotia Step Mortgage, there's an RBC Home Line Mortgage, there's the Manulife One, there's the National Bank All-in-One. Each lender has a mortgage product where you can add segments to it. And that's what a second mortgage is you have an existing mortgage with an existing lender. You want to tap into the equity of the home. You don't want to put it into a line of credit, but you want to basically just add another segment to it. And what that means is you're tapping into the equity. You have your existing mortgage, you're adding a second mortgage to it. And basically, that's how you're moving forward in that. A home equity line of credit is also adding a piece to that existing mortgage, but it's coming in forms of a home equity line of credit, which simply means that, hey, you have a home equity line of credit, you might have a limit of it on 200,000, you might have a utilization of it on 0, and you're not making any payments on it until basically that home equity line of credit is being used. Whereas if you're doing a second mortgage, you're getting that cash right away, and basically you're paying interest on it immediately. So that is what a second mortgage is. That is what a home equity line of credit is. And what a refinance is when you're actually breaking your current mortgage, you're paying the penalty, you're restructuring it, and then basically you're doing it all from scratch again.
So I got a quick question though, just quickly. So for someone looking to tap into their home's equity, what factors should they consider when deciding between a HELOC and a home equity loan? Like how did these options cater to different financial needs?
Well, again, a HELOC and a home equity loan is the same thing. So,
That's right. My bad.
it's like,
Yeah.
the question might be, should I do a home equity line of credit or should I do a second mortgage? Right.
Right. Yeah.
And one thing that you need to understand is that you, as a homeowner, you can only access up to 80% of the equity of your home, right? So that's number one. So a
Right.
lot of times, and we'll just keep it simple, a lot of times your property might be worth $1 million, right?
Yep.
So you can only access 80% of the home value. And in this case, if you owned $1 million, 80% of $1 million is 800,000. Say you have an existing mortgage where you owe 500,000, that means you can qualify, if eligible, for a $300,000 either in a second mortgage or in a home equity line of credit. Now, I find people will do second mortgages sometimes when they need that cash immediately. Like there's a lump sum of cash that needs to be paid out, or that there's a lump sum of cash that needs to be utilized. So they're going into a second mortgage because the interest rate is much sharper than if you're doing a home equity line of credit. Now, I find people who use home equity lines of credit, they are using those when they're going to use that cash at some point in the future, and they don't need it right away. And then because they don't need it right away, they're not paying interest on it until they use it.
Okay.
Right.
Yeah.
So refinancing, again, people who refinance, and again, Allister, always keep in mind when people are refinancing, they're breaking their current mortgage.
Right.
They're basically starting it all from scratch. And a lot of times people are refinancing when they're consolidating debt, when we're doing a
Right.
debt restructure, right? So when there is basically something that needs to be done in the immediate, sometimes it's, again, not in today's rate environment, but in the past, it was like, hey, this is the rate that I'm getting now. The rate is sharper, so this is why I'm going to do a refinance. A lot of times people are refinancing at the time of their mortgage renewals because they're restructuring their debt. Again, a lot of times, again, people who refinance are consolidating their debt. And basically, it's a good way of moving forward in doing that. Sometimes, again, jumping into the
I got one quick.
refinancing,
Right.
it's also affordability.
So I guess that's what I was going to say. Like, so with interest rates like constantly fluctuating, right? When would be the best time, I guess, to consider refinancing? And my guess from what you've been saying is sort of when it fits your needs.
Yeah, when it makes sense. Like when we're let's talk about, let's talk about August 28th of 2024. Why are people refinancing? Back in 2021, people may have been refinancing because the rates were ultra low, right? So they were refinancing to get a sharper rate.
Yeah.
People today will refinance. Quite often, they're going to have to refinance into a higher rate, but most people who are refinancing today are doing it because they've consumed a lot of consumer debt over the last 2 to 3 years, and now they're basically trying to restructure that debt, making it one payment. And again, a lot of times we're resetting that amortization and it becomes more of an affordability issue, right? They're restructuring their debt. They're injecting cash back into their pocket, one, two, maybe $3,000, depending on how much debt that you have. Yes, you are paying a penalty. Yes, the interest rate is higher, but again, you're consolidating all that consumer debt, the existing mortgage in one payment. And just on a file that we just worked last week, we injected $1,600 back into that client's pocket by consolidating the debt. And again, they were paying a higher rate than what they were paying before. They also had to pay a penalty and break of that mortgage. We reset the amortization to 30 years. And in doing so, again, we were injecting a large amount of cash back into this family's pocket each and every month.
That's incredible.
Yes. So again, home equity lines of credit, I think it's also important to know. I just actually had a client conversation today, and we were talking about, hey, would you like to access some of your equity of your home in forms of a home equity line of credit, also known as a HELOC? And
Right.
understand, if you are not great with managing your money, I'm not a very big fan of encouraging people who cannot manage their finances well getting a home equity line of credit, because it really is like a big bank machine. You can access it at any time. You don't need permission to access it. You basically you can use it whenever you like, however you like. But the problem is that if you use it and you're not good at managing debt, home equity lines of credit in when it comes to a lender, they're called never-ending loans, because most people will just do that interest-only payment. They will never pay that home equity line of credit down. And as a result, if you're not great at managing your money, can get yourself into some big serious trouble.
Well, is there like but in the flexibility versus stability, is there a balance? Is there a right balance based on their situation?
Well, in regards to getting a home equity loan versus a home equity line of credit,
Yeah, yeah,
well, the nice thing that people like the home equity lines of credit is the flexibility, because you can utilize your home equity line of credit, jump into it for $100,000, and then you can pay it off the next day without penalty, right?
right.
So I find that again, people who are um, who use their home equity lines of credit for appreciating assets, they like the flexibility of the home equity line of credit because they can utilize those funds, they can pay back those funds, and then there's no penalty in doing so. When you have a home equity loan, or again, sometimes a second mortgage that's being attached to an existing mortgage, understand that you're getting that money all at one time. It comes to you in one lump sum, and then all of a sudden you have a set payment on it. And the flexibility, if you wanted to pay that off, now you're gonna incur a penalty in doing so, because again, a home equity loan really just is another mortgage that you're picking a 1 year term, 3 year term, 4 year term. You're picking up to a 10 year term, and then if you do want to break that home equity line, then there's going to be a penalty in doing so because you're breaking the term. Whereas when you do a home equity line of credit, again, you can jump in and out of it that with no penalty. So again, I find that people who are investing in appreciating assets always like that home equity line of credit, especially real estate investors, for example, where they can jump in, they can utilize it, but also, again, if they're selling, they can pay it off, and then again, there's no penalty in doing that.
Okay.
So again, some other things to understand: why would somebody do a home equity line of credit, or why would someone do a home equity loan? Is the interest
Yeah.
rate, right?
Right.
So home equity lines of credit, their interest rates are typically prime plus a half. So right now, today's prime rate is 6.7%, plus 0.5. So that means that interest rate is 7.2%, right? If you
Right.
do a second mortgage or a home equity line or a home equity loan, right now we're getting 5-year terms for as low as 4.69%. So again, if it's not a flexibility concern, people will do home equity loans or second mortgages because the rates are going to be sharper than if you're using a line of credit.
Okay. I have a quick question. Just what are some common mistakes that homeowners make, but when deciding between like second mortgages and refinancing? Like, how can these pitfalls be avoided?
I think common mistakes is that people don't take a look at the overall cost of borrowing, right? A lot of times
Okay.
people will do a second mortgage versus a refinance because they want to avoid the penalty, right? And that does make
Right.
sense. But again, if you can break a mortgage, again, and everything is always different. But let's take a look when somebody is in consumer debt, right?
Right.
Let's take a look when there's a monthly affordability issue where you're having a tough time making ends meet. Sometimes people will do second mortgages versus refinancing because they don't want to break their existing mortgage to basically restructure. Whereas they'll say, hey, I got $100,000 of consumer debt. I'm going to do a second mortgage and add a segment to my existing mortgage. And then basically that's going to pay off the debt. But again, maybe your first mortgage has an amortization of 20 years and has a great rate. But if you reset that amortization, your overall monthly payment could possibly be lower. And yes, again, if you reset that amortization for 30 years, yes, more of that money is going to go towards the interest versus the principal. But again, if it comes down to an affordability issue, what are you going to do to make it more affordable for you to continue on a month-to-month basis? And if that means, hey, breaking your first mortgage, refinancing to basically do a debt restructure might make more sense than just adding another piece to it. So that I think that's one common mistake. The second common mistake is understanding that if you actually keep your existing mortgage and you add a segment to it, a lot of times your completion dates or your renewal dates are going to now be offsetting to one another. And then all of a sudden people will think, hey, if I got two segments, I got a segment 1 and a segment 2 mortgage. Segment 1 renews in 2024. Now segment 2 is going to renew in 2029. They are tied together. So if you ever wanted to break one, you got to break both. And then in doing so, you're going to incur a penalty on the one that doesn't have the same renewal date. So that's something that people need to be aware of when they are thinking, hey, should I add a segment or should I do a refinance? So again, not always an easy question to answer because
Right.
every individual is a little bit different as far as should I refinance, should I do a second mortgage, or should I add a home equity line of credit, right? So it's
Sure.
kind of like a case by case kind of scenario.
Yeah, I got you. I got you. What else, my man?
Well, I think that the key takeaways is just understanding that if you're only allowed to access 80% of the value of your home, right? We have
Okay.
conversations on the daily where people say, hey, I own $1 million home. I can access $1 million. A bank is going to lend me $1 million. Well, no, a bank is not going to lend you the value of your home. They're only going to lend you up to 80% of your home. And also keep in mind, then you also have to subtract the money that you already owe. So
On the
again,
yeah.
using that $1 million as an example, a bank is going to allow you to access 80% of it, providing that you qualify. That's another big thing. You need to qualify to access the equity of your home.
Yeah.
So let's assume that you do. If you have $1 million home, you're allowed to access up to 80% of it. So that's $800,000. If your mortgage is your current mortgage is 500,000, that means now the equity that you have available to you is 300,000. Right?
Exactly. And I think that that's one of the biggest things that people, that the misconceptions or misunderstandings that people have, it's that one right there.
Right. You got to qualify, and you also have to understand that
you don't have $1 million.
Yeah, and the equity that you're able to put into your pocket, you got to subtract what you already owe, right?
Exactly.
So that's a big one. Some of the factors to also consider is like if you refinance, there are going to be costs involved. So if you refinance, at times there's going to be an appraisal cost. If you're breaking the term of your mortgage, there's going to be a penalty in doing that, right? And then there's also going to be a legal cost as well, because you have to re-register everything.
Yeah.
When you're doing a second mortgage or a line of credit with an existing mortgage, at times there's not a legal cost in doing so. You're just adding on to what's currently there, because that mortgage is registered as what they call a collateral charge, right?
Okay.
So a collateral charge means that, say, for example, your home was appraised for $1.3 million. You're getting a mortgage for $1 million. So they'll register it on 125% higher than what the appraised value was for. And then it gives that room of equity growth. So if you ever need to tap into that equity, if the value is there and if you qualify, there is no legal cost because it's already registered for it. So when you're adding on to it and it's already there, there is no legal cost because that legal fee has already been paid when you originally did it, and then they registered that mortgage for a lot higher value than what is basically what you're paying on.
I got you. Yeah.
So again, that's the biggest things, and again, this 30-second roundup, right? And understand again, folks, you can only access 80% of the equity of your home. Here's another big thing. If you want it all in a line of credit, as per the Bank of Canada rules, you can only do 65% of that in a line of credit. Second mortgages, home equity lines of credit, you can add those onto what you currently have with your mortgage, providing you're in a mortgage product that allows you to do so, right? Refinancing means you have to break that existing mortgage. You have to pay the penalty in doing that. And then you're basically redoing everything from scratch. Now, again, people who do second mortgages or home equity lines of credit typically are people, say, for example, with a home equity line of credit, they're setting it up for future reinvestment or future purpose. People who are doing second mortgages will use that when they need a lump sum of cash, and they need that lump sum of cash for whatever reason they're going to use it for. Refinancing, again, means you're breaking everything, you're redoing everything, and again, at times, we're getting you that big lump sum of cash, right, as far as what the mortgage is, and then we're also setting up a line of credit for future reinvestment. So sometimes you're just restructuring everything and what that looks like. Why are people going to do a home equity line of credit versus a second mortgage and or a refinance? A lot of times it could be interest rates. Keep in mind that when you do a home equity line of credit, your interest rate is typically prime plus a half. When you're doing a second mortgage and or a refinance, you're getting that lender's best discounted rates at the time that you're doing it. Again, when you're using a home equity line of credit and you have a $500,000 home equity line of credit, you're only paying on the money that's being used. You're not paying on the limit. That's a big thing to understand. But again, if you get that $500,000 in a second mortgage, you're paying on that money right off the hop, right? Other things to factor in is the flexibility. People who love lines of credit love the flexibility, whereas you can use it one day, you can pay it off the next day, and there is no penalty in doing so. With second mortgages, again, the flexibility is a little bit more limited because if you break it, you're going to have a penalty in breaking it, depending on what that term you've chosen to do. And lastly, the cost.
But not leastly.
Lastly, but not leastly, remember the cost when you're refinancing. There's going to be an appraisal cost 9 out of 10 times. There's going to be a legal fee. There's going to be penalties for breaking that existing mortgage. But again, folks, sometimes it's a great thing to do if you're doing a debt restructure, quite often consolidating consumer debt, because in doing that and even paying all those costs, you're going to stick money into your pocket each and every month. So again, you have to take a look at the overall cost of borrowing. Second mortgages and lines of credit, there is going to be no costs or very little cost. Sometimes there's going to be an appraisal cost, but there's not going to be a legal cost because that mortgage was registered as a collateral charge, which simply means it was registered for a higher dollar amount than what your current mortgage is to allow you to access equity in the future. And then in doing so, you're limiting that legal cost when doing that. And that's really about it. So there's a lot of things to digest there. Hopefully we didn't go too fast. But again, those are your second mortgages. Again, you're adding those to an existing mortgage that you already have. Those are your home equity lines of credit. Again, you're adding those to the existing mortgage that you already have if the mortgage product allows you to do so. And then refinancing is when you're breaking everything, paying the penalties and doing so, and basically starting fresh.
That's beautiful, my man. Well done. Very well done. Well, I think that's it.
Lots there.
Yeah, man. Hey, amen. I think that's it for us today, man. I know I've got to run out. I've got to get out to a couple of showings. But I just, want to, before we go, I want to make sure I say once again, or we say once again, thank you so much for taking the time to listen to us every Thursday, Friday, Saturday, Sunday, whenever you get a chance to. We just appreciate the chance that you take. We appreciate the fact that you take the time to listen to us. We appreciate the fact that you take the time to download us and to share us, and we keep encouraging you to download us and share us and talk about us and love us and to leave us your comments so we can continue to improve for you. Man, enjoy this beautiful sunny weekend. I'm so excited that I've got this beautiful townhome coming soon in the lovely area of White Rock. So stay tuned. It's a beautiful place. It's a beautiful oasis. Yeah, man, I'm looking forward to the weekend. A little bit of rest and relaxation and getting out there and still working. Geoff, my man, I hope you enjoy the weekend and we get to hear all about it. Yeah, that's it for us though. All right, man. All right, that's it. Peace out. We'll talk to you all soon. Bye now.
All right, ciao.
Ciao.